Welcome to the deep dive. Today we're really trying to cut through the noise on Bitcoin. We want to chart its journey, from this sort of niche tech thing to, well, now it's a globally recognized macro asset. You really can't talk global finance without mentioning it.
That's exactly right. And our sources, they really hammer this home. The focus now is squarely on its core value. We're talking about that digitally enforced scarcity, its ability to resist policy-driven debasement. It's a stark contrast to, the risks you see with traditional fiat when the printing presses go burr.
Okay, yeah. Let's unpack that, starting right at the foundation.
Yeah.
What's the architecture here? What actually ensures that scarcity?
It boils down to the code itself. There's a hard limit baked in, 21 million points, period. That program scarcity, it insulates Bitcoin from the kind of inflation you get when governments just print more money. That's why people call it digital gold, right? The supply isn't decided by any central bank or politician.
Right, not just a promise, it's code. And the mechanism enforcing this. That's the halving cycle, isn't it?
Exactly, the halving. It's like clockwork, a predictable supply shock every 4 years or so. The algorithm literally cuts the reward for mining new blocks in half. We just had one back in April 2024. The reward dropped to 3.125 Bitcoin per block. So this ensures the new supply automatically tightens over time no matter what demand looks like. It's inherently deflationary by design.
Okay, so the scarcity is locked in, but what about keeping the network secure? If it's so robust and decentralized, what's the cost, the trade-off?
Well, that security definitely has a cost. It uses what's called proof of work, or POW. This guarantees the network's integrity across, thousands and thousands of computers worldwide, but it requires a massive amount of computational power.
How massive are we talking?
Look, estimates put the annual electricity consumption somewhere around maybe 194 terawatt hours. To give you some perspective, that's roughly comparable to the entire power consumption of a country like Thailand.
Wow. Thailand.
Yeah. So that huge energy footprint, that's essentially the functional cost you pay for having this truly unmatched decentralization and security. No single entity controls it.
Okay, so that intense security provides stability.
Yeah.
And that seems to be driving real action now, especially with institutions. This past year feels like a turning point, doesn't it? With the US-based spot Bitcoin ETFs launching.
Oh, absolutely. A watershed year, as some sources call it. Those ETFs were, frankly, incredibly successful right out of the gate. Their collective holdings shot up. I think the figures went from around $37 billion to over $60 billion quite quickly.
And that's not just speculative retail money, is it?
No, exactly. That kind of inflow signals something bigger. We're talking pension funds, serious asset managers looking for diversification. And the academic analysis backs this up. It shows Bitcoin doesn't really move in lockstep with traditional assets like, say, the S&P 500 or bonds. There isn't a strong unconditional correlation.
Okay, and why is that lack of correlation such a big deal for investors?
Well, because it means Bitcoin kind of dances to its own beat. It acts as an uncorrelated source of volatility. So for you, managing a portfolio, this offers real diversification benefits. It can potentially smooth out your overall returns, maybe even act as a hedge when traditional markets take a dive.
Interesting. So for the individual investor listening, what's the takeaway? Does this high-risk, high-reward profile fit somewhere?
Well, some of the life cycle models we looked at are quite provocative. They suggest that for, say, younger investors who maybe don't have a lot of capital yet, it might actually be optimal to allocate a significant chunk of their risk assets to cryptocurrencies like Bitcoin.
Right.
Precisely because of that unique risk reward and the low correlation benefit.
Right. Okay, let's zoom out then. If institutions are getting comfortable, what's happening on the regulatory front globally?
We're seeing some real movement towards convergence, but different approaches. Take the EU, they've been quite proactive with their MiCA framework. MiCA basically gives crypto companies a clear rule book up front. For instance, it mandates stablecoins must be fully backed by liquid reserves.
Okay, proactive in the EU. How does that compare to, say, the US?
The US approach has been more reactive, often focused on settling jurisdictional fights between agencies, sometimes after a major issue or collapse happens. Think about things like the Clarity Act, trying to define roles. That proactive clarity you see in the EU, that can create what some call a regulatory premium, attracting institutions that want clear rules before they commit serious capital.
So we have growing institutional interest, regulations slowly taking shape. What's the main hurdle, the primary long-term constraint still looming over widespread adoption?
It really comes back to what we discussed earlier, that environmental footprint, the energy consumption of proof of work.
Okay, so that leads us to our final thought for listeners to chew on.
Exactly. Here's something to think about. For Bitcoin to get truly widespread institutional acceptance, especially under increasingly strict ESG mandates, it likely depends entirely on the success and adoption of Layer 2 scaling solutions, things like the Lightning Network. These need to prove